What is a credit score? A credit score is a measure of creditworthiness or risk of defaulting on a loan. However, unfortunately at the moment, credit scores are inconsistent, they're confusing, and as my colleague just alluded to, they're actually quite unreliable. Hi everyone, I'm John, and today I'll be talking about a new way to credit score based on work that I've been doing with Kudos recently. Kudos are a challenger credit bureau. Their mission is to provide better credit for everyone. What this means is that through the use of transactional data and open banking, Kudos can allow lenders to make fairer credit decisions based on genuine financial behavior. With credit decisions, there are typically two aspects. How much can a consumer afford? And will this consumer repay the loan, or will they default on it? With my time at Kudos, I've been working on the risk side of the decision. So, how can we develop a credit score which is based on genuine financial behavior and can provide detailed personal explanations so that lenders can make credit more accessible and that decisions are more transparent to the consumer? In order to do this, we can use loan outcome data from a lender working with Kudos to build a model to predict the outcome of the loan, that is, whether or not the consumer will repay their loan or default on it. And once we have this model, we can then use this to produce a credit score. So, to begin, we can take the transaction data of a consumer, and we can apply Kudos' classification engine in order to label these transactions into categories such as income or gambling or utility bills, for example. And then we can generate credit reports which aggregate some of this information, such as monthly income or fixed expenditure. And we can also, from the balance history and the transactions, we can also generate more features, such as how many merchants is our consumer shopping at? Or on a monthly basis, what is the trend in our consumers' account balance? Is it going up or down? And how quickly? Are they overspending or underspending? And we can use this to train a random forest classifier to predict whether or not our consumer defaults on their loan. So, how does our model perform? In order to measure this, we need to consider the two things that lenders care about when they issue loans. How many loans are they making? In other words, what is the acceptance rate? And how many of these are not being repaid? In other words, what is the default rate? And with the modeling that I've done, I've shown that we can increase the acceptance rate by 40% and decrease the default rate by 46%. So, if we use this model to produce a credit score, we can show that we will then have a credit score which is based on genuine financial behavior, which will also help to make credit more accessible. But those aren't the only things we care about. We also need to be able to provide personal explanations to be able to explain the results of our modeling to the consumer so that the decision is more transparent as well. And to do this, we can use techniques from explainable AI research based on the mathematics of game theory to explain individual model predictions. For example, let's meet Alice and Barbara. Unfortunately, they were both rejected from their last loan application because their credit score was too low. But they don't really understand why this is the case. And when they look at it, they're told to register to vote, but it's not really sure how this actually affects their creditworthiness. If instead the lender could use a Kudos credit score, not only could they be given their credit score, they could also be informed about the factors which influence this score. In Alice's case, she's withdrawing a lot of cash relative to her income, and actually she's already taken on several loans. Barbara, on the other hand, has a bank balance that's consistently below zero, and she's got quite a few return direct debits. And in this way, both Alice and Barbara can now better understand the factors which affect their creditworthiness, and actually they can understand how to improve their creditworthiness from this. So we can see that if we use our model to develop a credit score, which can provide personal explanations, this will allow decisions to become more transparent to the consumer. In summary, I've developed a model which can produce an explainable credit score based on genuine financial behavior, and this will allow more access to credit and more transparent decisions for the consumer. And in doing so, this will empower the consumer to improve their own creditworthiness. In addition, this will also help Kudos to attract new potential customers, as it demonstrates the ability to extract predictive risk factors from transactional data. Thank you.